When you're looking for reliable income from the stock market, dividend ETFs are usually one of the first places you look. But there are so many of them. So which strategy is the right one? Well, today, we're going to put two of the absolute biggest names head-to-head, Schwab's SCHD and Vanguard's VYM. And to really get why funds like these are so popular, you've got to see this chart. I mean, look at that growth. It shows this investment category called strategic beta ETFs, which has just exploded, almost hitting $1 trillion. This whole space has changed the game for investors, and it's exactly where our two contenders live. So here's our game plan. First, we're going to talk about this idea of smarter income. Then, we'll introduce our two titans and really pop the hood to see what makes them tick. After that, it's performance time. We'll see how they've stacked up. And finally, we'll wrap it all up to help you figure out which style might be a better fit for you. All right, so let's jump right in with that first piece of the puzzle. What exactly is this strategy that's driving this huge trend? Okay, so what in the world is strategic beta? The easiest way to think about it is like a middle ground. It's not some manager picking stocks based on a hunch, but it's not just blindly buying the whole market either. Instead, these funds follow a specific preset rulebook, an index that's designed to zero in on certain factors like value, momentum, or in our case today, high-quality dividends. And this really gets to the heart of how these things are built. See, at their core, both SCHD and VYM are index funds. Their job is to track a benchmark, not beat it. But, and this is the whole point of our showdown, they track two totally different indexes, built onto completely different ideas about what makes a good dividend stock. All right, let's bring our two dividend titans into the ring. They are both absolute heavyweights in the investing world, but as you're about to see, they are definitely not identical twins. So, at first glance, SCHD and VYM look pretty similar, right? They both focus on U.S. dividend stocks. But right there in their mission statements, you see the first clue. SCHD is all about dividend quality and sustainability. They're looking for companies that can keep paying and growing those dividends. VYM, on the other hand, is just trying to give you broad access to stocks that already have a high dividend yield. Two very different goals. So, we know their philosophies are different. But what does that actually mean for what you're buying? To figure that out, we've got to look under the hood. And this is where it gets really interesting. SCHD tracks a super selective index of only about 100 stocks. And to get in, companies have to pass all these tests for financial health, like a solid dividend history, strong cash flow, good return on equity. It's a very focused, concentrated portfolio. VYM is pretty much the opposite. It holds over 500 stocks. It basically takes all the high-yielding stocks out there and just buys them. It's all about casting a wide net. Now, before we move on, one place where they are super similar, and this is a big deal, is cost. Both of them are incredibly cheap to own. We're talking hundredths of a percent. That means way more of your money stays invested and working for you, which is a massive win for any long-term investor. So, when you look at what's inside SCHD, you can really see that quality-first strategy at play. It's heavily weighted towards those classic steady-eddy sectors, like energy, consumer staples, and healthcare. Companies known for being stable and just gushing cash flow. Now, flip over to VYM, and it's a whole different story. Because it just buys the biggest high-yield companies, you end up with a huge chunk in financials, all the big banks. And what might be a little surprising is how much tech is in there. That's because some of the biggest tech companies in the world are now mature enough to pay out some pretty solid dividends. And no surprise, this leads to two totally different lists of top companies. I mean, look at that. They barely overlap. SCHD is packed with what you'd call classic dividend payers. VYM, on the other hand, is led by giants like the chipmaker Broadcom and the bank JP Morgan Chase. They're in there not necessarily because of their amazing dividend quality, but because they're just massive companies that happen to pay a nice dividend. Okay, so the theory is great at all, but let's be real. Results are what really matter. So how have these two very different approaches actually performed over the years? Let's get into the numbers. Just to build a little anticipation, let's start with SCHD. If you had put 10 grand into this fund when it first launched back in late 2011 and just reinvested all the dividends, well, your investment would have turned into this pretty impressive number. Okay, now let's look at the full head-to-head race. Over this whole period, ever since SCHD came on the scene, its focus on high-quality companies has paid off. It delivered a higher total return. That same $10,000 would have ended up being worth about $4,000 more in SCHD. But, and this is a really, really important but, you have to remember that looking at one long stretch of time doesn't tell you everything. The market moves in cycles, and what works one year might not work the next.
And you can see that so clearly when you break it down year by year. Look at 2024 and 2025. In those years, VYM's broader approach with all those financials and tech stocks actually led to much stronger returns. It just proves there's no single winner that's going to outperform every single year.
So, where does that leave us? Well, it's pretty clear this isn't about finding one fund that's just flat out better than the other. It's about figuring out which one is the right fit for you. And that brings us to the core trade-off here. The choice isn't really about which ETF is better, but which strategy you believe in more. With SCHD, you are making a very focused bet on what its index defines as quality. With VYM, you're making a much broader bet on the entire high-yield market. It's a classic trade-off. SCHD's focused approach versus VYM's wide diversification. Ultimately, the decision really boils down to this one simple question. What matters more to you? A hand-picked, curated portfolio of financially strong companies that have a history of growing their dividends, or do you prefer to own a little piece of all the high-yield stocks out there? Your answer to that question will probably point you in the right direction.
We hope this explainer helps clear things up and show you the very different personalities of these two dividend titans. For more tips on navigating the U.S. market, be sure to check out usmarketinvesting.com. Thanks for joining us.